Last quarter, Intel's Foundry reported $5.4 billion in revenue. Here's the number nobody quotes: only $174 million came from outside customers. The rest was Intel selling chips to itself. That same foundry lost $2.4 billion in 90 days. And yet Intel stock is up more than 160% this year. So which is real? The comeback or the accounting? If you like daily deep dives, subscribe now. July 18, 1968. Robert Noyce, who co-invented the integrated circuit, and Gordon Moore, whose name is on Moore's Law, walked out of Fairchild Semiconductor. They bought the rights to a better name than their own, Intel, short for Integrated Electronics. Arthur Rock raised $2.5 million. Andy Grove joined almost immediately. One idea: that semiconductor memory could replace the magnetic cores every computer was built around. Intel owned the design of the chip and the factories that built it. That combination was its superpower, and the thing that nearly killed it. The rest of the industry chose differently. Nvidia, Apple, AMD stopped building factories and handed manufacturing to TSMC. Intel kept its fabs. Then its manufacturing stumbled. Node after node arrived late. Rivals shipped better chips while Intel's own customers watched. The best transistor maker on Earth was suddenly a generation behind. See Intel today as two companies stapled together. Intel Products designs and sells chips. The laptop business brought in $7.7 billion last quarter. Data center and AI brought in $5.1 billion, growing 22%. That side is healthy. Then there's Intel Foundry, the factories, $5.4 billion in revenue, up 16%, and a $2.4 billion loss. One side earns. The other burns. The whole case is a bet on when that flips. Here's where that Foundry number needs an asterisk. Of the $5.4 billion external Foundry revenue, outside customers actually paying Intel to build their chips, was $174 million. Roughly 3%. The rest is internal transfer, Intel products buying from Intel Foundry, one pocket paying another. That's standard accounting, not fraud. But the foundry Intel wants valued like TSMC has almost no external customers. Everything depends on that changing. Full year 2025 is sober reading. Revenue, $52.9 billion, essentially flat. Earnings per share attributable to Intel, -6 cents. On a non-GAAP basis, 42 cents. For a full year, this company roughly broke even. It was once the most profitable semiconductor maker in the world. The numbers also aren't cleanly comparable, because Intel deconsolidated Altera in the third quarter. But the headline holds: that wasn't a growth year. It was a survival year. Then the first quarter of 2026 changed the tone. Revenue, $13.6 billion, up 7%, and $1.4 billion above the midpoint of Intel's own guidance. The sixth consecutive quarter Intel beat expectations. Non-GAAP gross margin hit 41%, 650 basis points ahead of guidance. Earnings per share, 29 cents against guidance of roughly break-even. Beat your own forecast 6 quarters running, and either management is sandbagging, or something is genuinely improving. Break the quarter apart and the story sharpens. The laptop business grew 1%. Basically nothing. Data center and AI grew 22%. That's the whole engine. The reason is unglamorous but powerful. every AI data center full of accelerators still needs conventional server processors to run it. Management expects double-digit unit growth for the server CPU industry into 2027. Intel isn't winning the AI accelerator war. It's getting paid for the plumbing around it. In August 2025, something happened with almost no precedent in modern American industry. The United States government took roughly a 10% equity stake in Intel, buying 433 million shares for $8.9 billion, alongside $5.7 billion in Accelerated Chips Act disbursements. Set aside the politics. It did two things: handed Intel cash exactly when Intel was burning it, and made Intel's factories a stated interest of the U.S. government. Washington wasn't alone. SoftBank put $2 billion into Intel in September 2025. Then Nvidia invested $5 billion, completed in December. Nvidia, the company that spent a decade eating Intel's lunch in the data center. The two agreed to jointly develop custom data center and PC products, pairing Intel's CPU technology and the x86 ecosystem with Nvidia's AI platform. When your fiercest competitor writes you a $5 billion check, that isn't charity. It's a judgment that you're too important to fail. All of it rests on manufacturing. Intel 18A is the node the entire turnaround was staked on, and it's now in production, building Panther Lake, Intel's first client system on chip on 18A. After years of delays, Intel finally hit a node. The chief executive says yields ran ahead of expectations and external partners started asking to be let onto 18A. But note the caveat: 18A's flagship customer is still Intel. Yields at genuine external volume remain unproven. April 7, 2026. Intel announced it was joining Terafab, a $25 billion project funded primarily by Tesla, SpaceX, and xAI, targeting 2 facilities at the Giga Texas campus. One for automotive and humanoid robotics silicon, full self-driving, the Cybercab program, the Optimus line. Another for AI data center infrastructure and processors built for orbit. Tesla selected Intel's next-generation 14A process, becoming its first major 14A customer, with SpaceX planning to use it too. Then the biggest headline of all. In May 2026, the Wall Street Journal reported Intel and Apple had reached a preliminary agreement for Intel to manufacture certain Apple chips on 18A. Apple, the company that fired Intel from its own laptops in 2020. But this is where investors get ahead of the facts. Neither company has publicly confirmed a final deal. Which chips, which node, production or pilot, none of it is public. Intel's chief executive said he expected formal commitments in the second half of 2026. That is not the language of a signed deal. There was a third name, and it may matter more than the rumor. Alphabet announced it would deploy Intel Xeon processors across Google Cloud's AI infrastructure. That's not a Foundry deal, it's a product win, and product wins have a quality Foundry promises don't, real revenue, this year, from a customer who could have chosen anything. 2026 gave Intel something it hadn't had in a decade. Not a better quarter. Momentum. Now the hard part. Intel's own chief executive calls 2026 an execution year and puts the growth inflection in 2027. The company is telling you the payoff is next year. Intel reported 41% gross margin and expects to approach 50% later in 2027, assuming 3 things go right: higher 18A utilization, faster AI server growth, and disciplined spending. If 18A profitability slips, the margin target slips with it. and the stock is priced for the target, not the slip. Intel's server share gains are real, but reversible. Analysts note Granite Rapids gains could unwind if AMD's Turin refresh ships on schedule. In AI accelerators, the market is consolidating hard around Nvidia, leaving Intel's gaudy a window that narrows every quarter. And in Foundry, Intel isn't facing a wounded rival. It's facing TSMC, with decades of yield learning and the trust of every major fabless designer. Intel must win two wars at once, against opponents who each only have to win one. Beneath the good headlines, the money still leaves. The Foundry lost $2.4 billion in a single quarter, improving by only $72 million from the quarter before. That's the honest pace of this turnaround, not a hockey stick, a grind. Intel remains loss-making on a trailing 12-month basis with negative free cash flow. Leading-edge fabs are among the most capital-hungry assets on Earth. The government money, the SoftBank money, the Nvidia money, that wasn't upside. That was the bridge. So what does the market charge for this? Intel's market capitalization sits around $540 billion, after a run of roughly 166% this year from a stock that started near $37. The multiples are extraordinary for a company that broke even last year. Price to sales around 12 times. Enterprise value to EBITDA around 93 times. Forward price to earnings around 162 times. Those aren't turnaround multiples. They already assume the turnaround worked. The disagreement on Wall Street is unusually violent. HSBC has argued for a target around $200. Bank of America has used the word bubble. And in July 2026 the stock fell about 21% in 7 days, which tells you how much of this price is sentiment rather than earnings. If Intel converts 18A and 14A into real external customers, and margin approaches 50%, today's multiple is defensible. If either leg breaks, there's no earnings floor underneath to catch it. Intel trades on the Nasdaq under INTC, and it's a large holding in most semiconductor exchange-traded funds, the diversified way in. But ignore the headlines and watch 3 numbers. 1. External Foundry revenue. It was $174 million. If that isn't in the billions by 2027, the Foundry thesis failed. 2. Whether the 14A commitments expected in the second half of 2026 actually get signed, and whether the Apple agreement is ever confirmed. 3. Gross margin walking from 41 toward 50. 58 years ago, 2 men left a comfortable job betting they could build a better transistor. Intel is now making a stranger bet, that a company can forget how to manufacture, and then remember. What makes this rare is who's standing behind it. Its own government owns 1/10 of it. Its fiercest competitor funded it. Its customers are becoming its investors. That's not how markets usually work. It's how nations protect an asset they've decided they cannot lose. Whether that makes Intel a good investment at 160 times forward earnings is a different question, and 2026 doesn't settle it. 2027 does. This video is for education, not investment advice. If this was useful, subscribe.